get your house in order. Cash is oxygen, and make sure you've got plenty of it. Capitalise your business, understand where your money's at, and how you can get your hands on it to go and buy some good opportunities for the next 2-3 years.
You are listening to the Property Developer Podcast, your home for tips, ideas and inspiration to help take your developing to the next level. Now here's your host, Justin Getty.
Hello and welcome to episode 68 of the show. Thanks for joining me. Continuing on with our series of COVID-19 discussions with thought leaders on what you can be doing during this unusual time. In this episode, I'm talking with Dan Holden about all things related to finance and capital and what you can be doing during this lockdown period. We cover things you can be doing, how the finance markets are reacting, should you delay your funding applications, should you be buying, and the importance of cash during these uncertain times. Dan's appeared on the show a number of times. The latest episode he featured in was number 56, where we talked about what you can be doing during soft times. I think that content is still relevant, so I suggest you go back and have a look for some other ideas about what you can be doing at the moment. Just a quick project update. My project is in pre-construction mode, so we're just waiting for services to be abolished, tidying up some paperwork, applying for building permits and other permits, just getting everything ready to go. So we're pretty close, still looking at demolition next month, which will be exciting, starting to get some big machinery on site. Okay, let's kick off our conversation with Dan Holden about funding and finance and what you can be doing during this coronavirus pandemic. Dan Holden, welcome back again to the Property Developer Podcast. I think you're the guest who's been on the most number of times. So it's always good to have you on.
Right. Yeah, it must be 4 or 5 times, yeah.
No, it's good that...
Thanks for having me.
No, it's good that you keep accepting the invites to come back and talk to us.
Yep.
So I've been doing a series of conversations with people around what they can do during this COVID-19 pandemic that's sweeping the world and certainly affecting us here in Australia. And finance is always a big part of the property development game, and getting the finance right in a time of uncertainty is always a sort of big question. So I thought, let's talk to you about what your thinking is around what property developers can be doing during this time of uncertainty and what's happening in the capital market. So can you give us your thoughts on what's happening, what people should be doing? Is money still out there? All those sort of big questions that people will have.
Yeah, so I think to answer the first question, should I guess what should they be doing in the current time? I guess using the downtime efficiently. One thing we are seeing or having a lot more focus on is the actual sponsor, the developer, and their background. So actually taking the downtime to get all of that ready. It's going to be question 1, 2, 3, 4, 5 when talking to a lender. So having that information available, ready, prepared, packaged is, I think, a good use of time at the moment. And that includes financial capacity, A&Ls, cash flows, historical cash flows. Here's the last 5 projects I did. Here's the FISOs of them. Here's how much cash I put in. Here's how much cash I got out. Here's the debt structures I used in the past. It's something that I guess outside of the current economic times we're in, it does get glossed over by both the borrower and sometimes the lenders as well. I think it's something that at the moment is very important. It's something that I guess we look at, particularly on some projects where it's where the developer's putting in minimal capital. We'll go back historically and want to see the last couple of projects they've done, how successful they were, what went wrong, how much contingency was used, all of those things, and the developer should have that information available, being able to package it up. Once you do it once, it's done, and then you've got it available for the future. So spending a bit of time to get all of that prepared and show the historical, but also showing so that's one side, and it's probably 2 pages of information. It's not much, but that level of detail is very impressive for a lender to look at. And then looking forward as well to say, well, here's my fixed costs, my variable costs in the business, and having a cash flow that we can see the group within the group, all the projects that you've got. It might be 1, it might be 11, and seeing when they run off, what debt pieces you've got, putting them in a timeline so that we can see debt expiry, debt exposure. Do you have 4 projects with 1 lender? Is that a risk? And being able to map that out. And again, that's only 2 or 3 pages of information, but it's very good information to have pre-packaged at your fingertips, ready to provide to lender for your next project. So it's taking that time to prepare your own information so that you are presenting as a quality borrower and a savvy property developer, entrepreneur, I guess, is where you should be positioning yourself and using this time to actually have all that information up to date, ready to go at your fingertips.
I would have thought
probably
that
also say
you want to know anyway, Dan, stuff you'd like to have a picture of your business anyway.
It is, and people should. I think a lot of people, as I say, gloss over it. They focus so much on the property, the project, that it's times like these that lenders are going to spend a lot more time looking at you. So have your own information ready is essentially the message there. And the other thing is, I guess, don't do it alone. So talk to your advisors, your accountant, your solicitor in terms of structuring risk, mitigation, and finance broker. Have a chat to them. There's a lot of value that we add our team here beyond just getting a well-priced debt package. It's how do you structure your pipeline of projects? How do you repatriate capital back? Make capital available. How do you have capital available to go and buy another site? If you're looking at the moment, vendors are getting a bit more conditioned and ready to sell. Do you have 2 million cash sitting ready to go and jump on that next site, settle in 14 days? Like that's the opportunity, and making that opportunity available within your business that you should be looking at right now.
And so from a project perspective, are there types of projects that you would say hold off on making an application unless it's particularly strong, or is it, I'm hesitant to say the word business, but would you keep ticking on a standard type project?
Absolutely. And, residential people need somewhere to live. I think retail is probably a little bit tough at the moment. A lot of retailers aren't even open, let alone trading successfully. So that definitely hampers it. A lot of rent reductions going around. That also creates opportunity. I've spoken to a few developers recently who are out there trying to buy some under rented and hurting retail tenancies, with a view that over 3 years they'll trade up and let out and be a good asset long term. So it's probably it's not so much what you would avoid, it's what you would probably not jump into if you're not currently doing it. And in lending, they're called specialised assets that most lenders will lend less on or avoid, like childcare, service stations, aged care, retirement. All of those specialised assets are I guess something that you shouldn't be venturing into if you haven't done many of them in the past. I'd say it's more a case of sticking to your knitting. I mean, if you've just built 10 service stations, sure, build another one, but I wouldn't be out there trialling an error at the moment. That's not the time for it. So I think in terms of picking projects to do, it'd be stick to your knitting. And
are lenders still out there? I'm hearing of capital being withdrawn and some people holding off on lending money, just waiting to see. What are you finding?
Yeah, definitely it's different. Quite less players. Lenders are holding their capital back. We're seeing people do lending on reduced gearing because they're not sure or comfortable, with what the valuations might do in the coming 6 to 12 months. Some lenders have completely shut shop, and there's a few reasons for that. One might be that their capital source is shut. Whether they get money from overseas or money from mums and dads, or they've got a pooled fund and their fear of redemptions. It doesn't take many redemptions on a pooled fund to make the cash available pretty small, and funding future drawdowns and what have you. There's quite a few lenders that shut. Hopefully it's temporary, and that they're back open again soon once it stabilises. And I think that's the key thing. Late March, there was a lot of phone calls that we were getting from lenders saying that they're shut, and hopefully once things stabilise, normalise, people can get a better picture of what's going to unfold in the coming weeks and months, that they can reposition their book, recalibrate their book in terms of cash available and commitments that they've already got, and then have a better picture into the future. If you're managing a pooled mortgage fund, it'd be pretty, I wouldn't say scary, it'd just be a risk that you've got of, if you're relying on projects to repay, to then pay the next, do future projects. And those current projects, you might get titles and call for settlements, but if the buyers aren't able to settle, which we've seen a few cases of, not falling over, just delays to settlement, then you're not getting your money back to fund the next project. So it becomes a bit of a catch-22. And so some lenders have had to, I wouldn't say shut, I'd say pause is a better word.
Yeah, and when you say how things stabilise and pan out, what does that look like in your mind for lenders?
So I think it's a lot around the valuations and the settlements. If you're managing 300 million and you're expecting 30 million back this month and it doesn't come back because the buyers of the end product of the last project can't settle because they are getting delays in their bank funding. You're used to getting in 30 mils and lending out 30 mil every month in a 200 mil fund. When that slows down, it just slows everything down, and it kind of truncates everything back. So it's more just assessing it all and getting an understanding of it. We did, unfortunately, we saw some borrowers get mucked around by lenders. Thankfully, none that we're involved in, but we've had a lot of inquiry from people saying, hey, I had a formal letter of offer here and I've just been told the money's not available. It's created a bit of a panic, and it's also created, I guess, a massive spike in inquiry for stuff that we've been dealing with, trying to find new homes for projects to fund, and likewise, even just down to settling a site for the next project or residual stock, even doing like little mezz top-ups to capitalise interest. We've done 2 of those in the last 5 or 6 weeks. So an example of that, you might have a 10 mil loan and you've now got to pad out. You're expecting to pay most of it back in May, and you've now got to assume the worst, that it might be take until August to pay that out, another 4, 5, 6 months for those buyers to come in and settle that and pay that, extinguish your debt on the project. So you've now got to capitalise your business essentially. So we've been doing a few what we call equity redraws. It might just be 1 or 2 mil top up on a project, and that just lets everything stabilise and settle. You're not panicking, and or we've done complete takeouts, residual stock refinances. So you might have 10 mil. We did one just recently. It was, I think the initial debt was 8.8. We did a new loan of 9.6, and that reset the interest for the next 12 months. So it has pre-sales. The project was fully complete. It had titles. They were calling for settlements. Buyers couldn't come and view the property to then do their pre-settlement inspection, get all the fundings in place and all that kind of stuff, interstate lenders and what have you. And so we recapitalised that debt for another 12 months, and that then takes the stress out of it for the developer, that they're having to find, on 8.8 mil, you'd be finding a fair chunk of money every month to service that interest. So we recapitalised that whole facility, took out the construction facility, a new first mortgage at 9% per annum, and it'll now sit there comfortably for the next 12 months. Then after panic sell, fire sale, they can, feed the balance stock to the market. Those buyers that are there and do want to settle, willing buyer, willing seller. It's just the logistics of getting the settlement to happen that is slow at the moment. So that's some examples of things, I guess, that we've been doing and rushing in to do over the last probably 6 weeks since it's all started to slow down and unfold.
Yeah. And what kind of projects are you going to get in trouble?
Undercapitalised ones that are, sitting there with a small layer of equity and not enough interest cap. They're the ones that are going to get in trouble, and the lender's tapping the borrower on the shoulder to say, mate, you've got to start servicing this debt, and if they can't service it, then it's in default. All of a sudden you're paying, instead of paying 8% per annum construction funding money, you're paying, I don't know, 13, 14, 15%. I don't know what your default rate would be, but it'd be higher. And so coming in to reset that debt, we're doing quite a bit of. So yeah, projects that will struggle are ones that are undercapitalised and don't have a clear strategy and can't withhold another 6 months of not being in a panic and fire selling and taking deep discounts and panicking basically.
And what do you think in the construction sector, what's going to happen with building and prices?
Well, thankfully, it's been classed essential and it's still been going. Talking to some builders that we're building projects we're currently funding, we did have this discussion with a few of them. One of them said to add 15% to your timeline, nothing to your cost. Labour might be cheaper, materials might be about the same or a bit more. And it's just more timing. One of the first closure or distancing measures was it 100 people or whatever? And so some projects, bigger projects that we're funding, have 200 people a day at peak. And so being prepared that might be, working in shifts and add a bit of time. So adding 15% to the time is I guess what we've been told by a major builder here in Brisbane, and we agree with. But not too much impact on costs we're seeing yet. And with China being back open, we've got one project waiting on lifts from China, and it was an 8-week delay, and they're due to arrive in Australia end of April, so hopefully next week.
And are you forecasting or anticipating that there'll be some distressed sales over the next 3, 6 months, 9 months?
As in completed projects, apartment, like that type of thing, or you mean site sales?
Yeah, sites or projects that maybe fall over in between because they run out of capital or the capital gets...
Yeah. I mean, I think now you see, those distressed sales or, going cheap. Sometimes it's a function of the seller being in a desperate position. I tell you, a lot of time it's actually a function of the buyer being savvy, smart, sitting on a pile of cash and just making a really cheeky, short time frame cash offer. I know a few of our clients are sitting on cash right now and starting to make cheeky offers because you just don't know what the seller's position is, or maybe they're just fatigued and they're just, I wanted to sell this site for 4 mil, but geez, 3.2 at the moment would be bloody great. And they probably, who knows, they might not even be in distress. It's just that they go, okay, I'm done. Emotions are a big factor in decisions at the moment. And sometimes people talk about distressed sellers. I think it's actually, you've got to think at the opposite equation, which is actually savvy buyers, being smart, being prepared for these situations, having a good amount of capital on standby, and having a good business model and a good approach to these things, and jumping in and buying things. So, there's two sides.
Yeah, well, it certainly felt for me like 2 or 3 weeks ago, there was a lot of uncertainty and fear around quite broadly. I kind of get the sense maybe that's settled back just a little bit, but just never know what's going to happen. And what about gazing into your crystal ball and forecasting what might happen in terms of property specifically, given we're probably not going to have any population growth over the next 12 months, 18 months. Unemployment's probably going to go up. What are you thinking more broadly?
I think in terms of for the next 3 to 6 months anyway, if we break it up that way, it's working through what's currently in the pipeline. As I said, we haven't seen any settlements of the completed product faulty yet, which is great, and hopefully they're just delayed and they do settle. On a longer term view, definitely employment will make a decent impact to property and confidence. It also brings out the people who see that as opportunity to buy now, because most investors should have a 5, 10 year, longer 20 year generational view on property, not a week to week view. And so if you're investing in something at the moment, you should be still confident because in 5 years from now or 15 years from now, it's going to be a good buy. So I would also just look at it from that point of view of going, well, there are still people who have jobs. There are still people who can borrow money. And if you were, I guess, on the sidelines or marginal to be lent money to as an investor, like, if you're building a property development project at the moment and you're relying on those marginal borrowers to buy your project, then that's not really a good sound business model. I'd be saying if you're doing good product in good locations, close to amenity, and a good, enjoyable lifestyle created by it, that people are still going to buy it. People need a place to live. So I'd be saying it's still going to tick along, and so long as employment, they're saying it's going to go into 10, 11, 12% category, but I would think that that's temporary until things open up again and start trading again. I think it's also probably given people a little bit of a jolt in terms of what their focus is and how close to the wind they might have been sailing and they didn't know it. It's definitely I guess created some opportunity for some of our clients who are out there and who are cashing up at the moment via, as I said, either those equity redraw facilities we're doing on their current projects, so that they've got $3, $4, $5 million cash sitting there to go and buy things, so that they're in there. And some of our clients made great money in the post GFC market because there was less people competing on sites, and they were building projects that had a 18 months, 24 months timeline to get product on the ground. So, they're taking a view that it's not about the third week of April 2020. It's about, delivering product in the middle of the year 2022 and having good product at that time that's close to good amenity and is actually desirable product.
Yeah, and you'd have to think that once this sort of passes, property will be one area that governments look at to really pump prime just because of the multiplier effect that it has. So I think there'll be some opportunities when that time comes as well.
Yeah, well, you would hope so. I mean, they're doing a lot to shore up businesses at the moment and business confidence. So you would hope if property starts to falter a little bit that they jump in some way, shape or form, which, like you say, they've done in the past.
Yeah. So don't hold off on buying necessarily, is what you're saying?
I think if you've got a sound business model, you'd be probably tentative for the last 6 weeks, and based on the way that the virus side of things is curbed as at the third week of April, you'd expect the economy to reopen in the coming months, and that it's going to hopefully have been a hiccup, and you'd be back out there putting in place your 5-year plan. I mean, I've said it a couple of times. You don't recut your 5-year plan every 5 weeks. It's in place. You don't rethink it. You don't change it. Sure, if the whole economy dropped 20% and it was absolute disaster, you'd revisit it. But you should be investing for the long term, and you should have a business model that is long term. And you need to assume that it's going to span cycles. Property market, share market, everything's always gone in cycles for generations. Whether it's 5 years, 7 years, 10 years, it's always had a cycle. And so if your business model doesn't take into account that things are going to go in ebbs and flows, then it's not really a business model, is it? You can't be fair weather sailor all the time.
Hit and hope. Well, it's kind of weird because we were coming out of a sort of down cycle, weren't we? And things were looking fairly promising, and then this has swamped everyone, and it looks like it might impact and have head towards a downward trajectory again. But as you say, whenever it goes down, it eventually has to come back up.
Yeah, and as I say, if you're doing a 2-year project, then you're not worried about May, June 2020. You're worried about the future, and you should be just worried about delivering a good product. That should be a major focus.
And do you think there's going to be a surplus of stock in, say, 18 months' time, 2 years' time, when we've got no growth in population and construction and building still going on and completions beginning?
Yeah, I think, like you said, we previously went through a bit of a a glut of stock across all three eastern seaboard cities, and what you found is that very quickly, as there was oversupply, less projects came on, and so the supply drops generally in tune with the demand. So you would hope that less projects may kick off going forward from today, in a sense that it's either the barrier to entry is higher from funding or just getting the project to stack, or secondly, that more projects get deferred and therefore we don't have a big wave of projects all settling and hitting the market at the same time. I also think, getting pre-sales over the next 6 months is probably going to be more challenging, and getting them qualifying pre-sales as well. Normally in this kind of a phase, you see buyers reluctant to commit fully and pay a full 10% deposit and commit to a project that hasn't yet started. So you see that buyer reluctance when it's just hoarding on a site. The developer's saying, "Yep, trust me, I'll get started soon." You start seeing a bit of reluctance from those investors to buy that product, and so you see a bit of a shift there as well in terms of the requirements for funding. That it has a bit of a shift as well. So then you see I guess the developer that does projects in the tougher times is generally has a strong balance sheet, can weather the storm of holding a project for more than 4 to 6 months at peak debt, and can start projects without pre-sales, either because they're very bankable client with a good project, and they pick up sales along the way, and we're probably going to see more of that type of funding required in the coming months.
Yeah, and I think once the pandemic passes and people start looking to move back or move into Australia, or the immigration starts up again, I wouldn't be surprised to see more interest in people wanting to move to Australia, given that it's a fairly safe and healthy perception of being a healthy country. So you might get a lot of wealthy, healthy migrants fleeing to Australia.
Yep, absolutely. I mean, I was talking to a fairly prominent developer the other day. Well, it must have been about 3 weeks ago now, and it was just as that second stimulus package was announced, and he said, I said, "Oh, how are you feeling about things? We're in a couple of hundred apartments right now," and I said, "How are you feeling about everything?" He said, "Mate, I don't know. I don't know if I'm too optimistic, but they've just spent a couple of $100 billion in the economy. Interest rates have never been lower. Employment will take a temporary hit, and hopefully it comes back. Think forward to September, October, November this year, and we've got all this money awash in the economy, and some confidence comes back to the economy. You've got a great recipe there for things to really kick."
Yeah, well, let's hope they're right. But yeah, coining these new migrants coming in that are healthy and wealthy as wealthies fleeing to Australia. Anyway, we'll see. Tell me, what's something that you've learned in the past few weeks in response to what's been happening? It's been a strange time.
Yeah, probably one of the things I've learned, and some developers the hard way, is that some lenders that you expect to be there may not be. We've seen some pretty sizable lenders pretty much just pivot on a dime and stop lending.
Name.
It's a bit of a shock.
Name.
No, I think it's fairly well known who they are, but and also, even in the last 2 weeks, our office has been contacted 7 or 8 times by new shops that have popped up out of nowhere, claiming to have a couple of $100 million to lend out. Minimal experience in the space. There's a lot of time waster people popping up out of nowhere, and it's just do your DD on who you're going to borrow money from. Are they going to disappear as fast as they appeared? There's a lot of homework to be done around just lenders in general. There's a lot of questions that you should be asking. Of the lender, how they fund the project, what they do, what loans they've had go bad, what did they do. It's the time to be cautious on who I guess ultimately you're getting into bed with. as a lender. It's really critical. We've seen some pretty shocking things happening in the last couple of weeks, and it's unfortunate both to see lenders treating borrowers pretty poorly, and to see brokers just saying whatever they have to get a deal done. In these times, it's pretty scary, and unfortunately, sometimes we have to deal with those developers after they've had a unfortunate scenario, and it's frustrating. Frustrating for us because we just want to get in there and help the people, but they're so wired out that after you've had a bad experience, asking a few precautionary questions up front may have prevented that from happening, and a good developer being left in the lurch from a lender or a broker representing what they can and can't do. It's very disappointing. So yeah, second point would be a lot of time wasters and future train crashes ahead, unfortunately. But overall, as I said, there are a lot of people remaining positive, and a lot of people who have a 5-10 year plan are multi-generational developers. They're out there going, this is the wave of the cycle that was going to happen, in a sense that the market wasn't going to keep going up at 8% per annum forever. It's not China. It's a manufactured economy. It goes and ebbs and flows. You've got to be ready for the next ebb and flow to happen and have a plan for it, not be reactive to whatever's happening in the daily announcements on news.com. It's taking that long-term view, investing for the long term, and having contingencies that mean you can hold a project for 4 to 6 months at peak debt and not freak out. I think that's a big message that we've seen some people calmly, confidently getting on with their business, and if anything, being cashed up, ready to go and buy again, and other people are hamstrung and really freaking out.
And do you think it's going to, regarding the capital markets and a lot of those private lenders or secondary lenders, do you think it's going to flush out I don't necessarily use the word cowboys, but the sort of maybe the opportunists that came into the market because banks had withdrawn, and it's sort of going to flush those groups out?
I think it will, and I think it will more in the way that they treat their existing borrowers, because if they're in it just to make a buck and lend 300 million and turn it into 400 and then disappear, then they're going to just be ruthless. Whereas the good lenders who have been operating for 10, 20 years and they're in it for the long haul, they want to work with the borrower, developer, to get them out of it and fund them again into another project. The best borrower is one you've lent to, and you want that repeat business as a lender, and us as a finance broker, we want to keep working with those people time and time again. So I think the cowboys, as you say, for want of a better word, are the ones who are going to be ruthless and just tip you up and kick you out. And we're already seeing that in the brutal way that some of the lenders are dealing with some of these people, the borrowers, developers. So yeah, I think it'll be a challenge for those people. Also, probably in defence of some lenders who have shut shop, 3 of them I know who I've known for over a decade or more, and we've done business with, have shut shop for a semi-positive reason, because they're multidisciplinary. They're now looking at, do we lend money and only get 9%, or do we go and buy some of these fatigued, rundown retail assets that we can then turn over? So, those guys who have shut shop isn't necessarily because lending's now high risk. It's just that there's better opportunity for them out there to deploy their capital into other opportunities, sectors, or strings to their bow of their business, that they then go, well, why would we lend 300 mil here when we can go and buy 4 or 5 assets over here and turn them over in the next 3 years and make better money or lower risk or whatever. So it's not necessarily that people are fleeing the sector because it's now high risk. It's also there's many different ways of why they're not doing. But also there's some, like we're still raising money. We just raised 2.4 mil and settled a deal yesterday for a nice little dual house up here in Brisbane. think we've raised about 30 mil in the last 4 weeks. So the investors still have appetite, and also, investors investing into these mortgages getting 9%. It's good. It's safe. It's boring. It's you don't have to think about it too much. It's like, plenty of our investors have still got appetite to do things and get involved. It's just they're not doing they're not taking on anything super crazy and speculative. There's things still happening, that's for sure.
Yeah, which is no bad thing.
Yeah.
Anything too crazy, which is what tends to happen when things start heating up, don't it? People start taking more risks.
Yep.
And what about something new or different that you're doing now?
Every lender is taking a stronger emphasis on sponsor, cash flow, and business model, or lack thereof. Surprising how many people realise they don't have a business model. They're just deal-to-deal junkies. Our team's been really busy. I guess the slowdown has just and some of the lenders playing brutally to some borrowers has created really strong inquiry levels for us. We're just sticking to, I guess, our knitting in a sense of just helping developers and getting them the funding they need and negotiating deals to get them some good outcomes. I think most importantly is it's just knowing who's open and who's closed. And unfortunately, there's no yellow pages of funders. It's you've got to be talking to them daily like we are and understanding they might be partially closed and happy to do some deals, or the way you present the deal to them is what excites them and how to push some buttons and get a result. So I think what are we doing new and different is big focus on the borrower. Why are they a reliable borrower, trustworthy? Are they prepared for things like this, or did it catch them completely unawares? Because that's what you obviously don't want to kind of see people freaking out.
Yeah, it's interesting.
So it's a lot more focus on the sponsor.
Yeah, well, in terms of something new and different that I've been doing lately is doing a lot more phone calls to people that I haven't spoken to for a while. And it was funny, last time you and Steve were on the show, it was during a softer market, and a piece of advice Steve had was to get on the phone and talk to all sorts of different people from across the industry or the markets that you're involved with. And I've been doing that the last week or two, and it's actually been really great. Just you ring people up, chat to them, you haven't spoken to them for a while, ask them what they're thinking, what they're seeing, and it's amazing what kind of information and just connections you can make just doing something as simple as some phone calls.
Absolutely. Yep. It's the time to stay connected and see what people are seeing, so that you can make better informed decisions. I mean, that's what it's about at the moment is getting as much information as you can, make an informed decision. And also, I think customer memory back to the GFC, the worst thing people can do is indecision, to not decide, not actually make decisions and keep getting on with it. Being paralysed and freaking out and thinking the world's going to end is definitely not a solution. You've got to be decisive. You've got to get on with it, and you've got to, as I said, have that long-term plan. You're not a week-to-week investor. You're a decade cycle generational investor. So that's what you should be focused on, is creating wealth for your family and financial freedom and thinking long-term.
Yeah, I think in a crisis like this, you also get an opportunity to see how people in your team or that you're working with react and respond. And if they're experienced or calm and can help you through it, I think that's a really good sign for the future. Because you get all these sort of people that pop up in really good, strong markets, and they make out that they're hot stuff at what they're doing, but then when things go bad, suddenly they kind of don't really know what they're doing.
I've had phone calls and emails from so many home loan brokers the last couple of weeks that are out of their depth and doing exactly that. Particularly with some of those bank and minor bank funders that have not shut shop, but raised the bar of entry massively. These guys have overpromised to customers, and now they're freaking out and coming to us saying, "Please help." And it's not nice to see people get left on the lurch like that.
Okay, well, some people have a bit more time on their hands. I think I spoke to someone recently who suggested people continue working furiously over this period of time so to set themselves up, but people are home a bit more than normal and maybe have a bit of extra time on their hands. So you got any books or movies or suggestions for what people can do with maybe their downtime?
Yeah, my main message is to get your house in order and have a good understanding of your history and your future in terms of cash flow. Cash is king. Cash is oxygen for your business. Where is it? How does it come into your business? And where does it go out? What are you spending your money on? What are fixed costs? What are variable costs? And so to get to that and have a clear picture of that is to get information. So the three things that I've got suggestions for this question. First of all, our podcast. So we do a podcast called the Constructive Finance Podcast. I think we've done 40 odd. The first, I think, 35 interview people, as in other developers, lenders, builders, valuers. But the last 5 we've done specifically on products like site loans, or we did one on residual stock loans. We did another one on construction debt. I think we're about to do one on mezz and pref equity. So get the lingo, get the understanding of the product, understand the benefits to non-bank specific construction lenders, or the pain and frustration of the long process of dealing with a bank, but is it worth the benefit? Understanding all of that. So our podcast, we've also got a dictionary on our website, a glossary of terms or whatever. So just getting up to speed with all the lingo. The second recommendation is a book. It's called Profit First by Mike Michaelwitz. It's all about getting your business cash flow in order. As I said, the way your money comes into your business and it goes out of your business, and just understanding how that flow of money happens within your business. I think that's critical. Few people finding out the hard way that cashing and cash is oxygen. So the second one would be, the third one, a simple one, the Barefoot Investor. Make sure your home cash flow is in order and doesn't require, if it was in order, you shouldn't have had to be reconfigured. If you've had to look at your home cash flow or your business cash flow in the last 6 weeks, it's probably because you weren't across it and monitoring it regularly, and it probably wasn't set up properly in the first place, right? So, Profit First for your business. Book, it's a book. I think it's an Audible book as well. And Barefoot Investor, which I think is a book and an Audible book. And there's Barefoot Investor for families as well. Get your kids in it. Play the money game with your kids. I've been playing the pocket money game with my kids and having a ball. It's great. So educate, get information, and have all of that stuff in place. And that makes our job helping you and structuring your projects easier if you've got that information available. So use this downtime to get your house in order, get your information in order. It should be all readily available at your fingertips. Have a business model, have a cash flow, have your house in order. That's the key message from today, mate.
Yes, well, your podcast is really good. I'm always a keen listener whenever a new episode comes out. And yes, your dictionary and the product guides and information that you put out from time to time that is on your website, it's certainly worth the time. So if people want to grab that, where should they go? holdencapital.com.au?
Spot on, yep.
Very good. All right, well, any last parting words of wisdom for listeners out there?
No, mate, I think I've said it 7 times. Get your house in order. Get your cash is oxygen, and make sure you've got plenty of it. Capitalise your business. Understand where your money's at, and how you can get your hands on it to go and buy some good opportunities for the next 2-3 years.
Yeah, well, there's a great saying that you learn good habits in bad times and bad habits in good times. So take advantage of what could be perceived as a bad time to really get yourself set up for future success.
Yep, absolutely. Come on.
All right, Dan, always good to talk to you. Thanks for
Thanks,
coming
mate.
for however number of times it's been. Hopefully we'll have you back in the near future to talk about all the great opportunities that are available in the markets and capital's flowing again.
Yeah, happy to. Cheers, mate.
Well, awesome. Thanks.
You've been listening to the Property Developer Podcast. Tune in next time for more tips, ideas and inspiration to take your developing to the next level. For more developing love, make sure to visit propertydeveloperpodcast.com.